Lesson 4, the game of support and resistance. Now this is really going to amaze you, because when I discovered that trading was nothing more than a financial game, then my focus went into understanding what the rules are and understanding how everything works, understanding the objectives, because in understanding that, it really participated in my profitability and will participate in your profitability once you understand it. So let's get started. By the end of this lesson, you will learn that trading is a financial game with two sides, the bulls and the bears, how points are made between the bulls and the bears, and that each side is trying to score points against the other side, that traders try to capture pips as the bulls and bears fight for control and try to score points. How to find support and resistance. These are critical levels. The importance and significance of knowing where these critical levels of support and resistance are, that support can become future resistance and you can enter selling there. In the same way, resistance can become future support and you can enter the market buying there. More importantly, how to profit take and exit the market before it hits a past level of support or resistance, how to place your protective stop loss orders a little beyond past levels of support and resistance, and never trade without a protective stop. Now you really need to think about how the market moves, and you need to keep it simple. The market can only go up, down, or sideways. That's all it can do. Now, trading is a financial game between these bulls and the bears. Bulls are trying to score points against the bears. As the market moves up and the bulls make new highs, that's how they capture a point. Make a new high, score a point. Bears are trying to score points against the bulls. How do they score points? They drag the prices down. Whenever they make a new low, they score a point. Now here's what I want you to get in the habit of saying to yourself. Score a point, pull back. Say that again. Score a point, pull back. What does that mean? Okay, look at how the bulls were in control here. And then the bears took control. When they came down, they took out this low. They scored a point. Pull back. Then the bulls took control. Look at how they rallied up here, took out this high, scored a point. Pull back. What does that mean, score a point, pull back? If I'm buying the market for whatever reason, okay, let's just say I got in on this engulfing bullish candle. What I want to do is find my most recent high and figure out if it aligns with my equity management of risk versus reward and get out before it hits that point. Why? Score a point, pull back. Look it, if you bought here and you didn't get out here because you don't know where to get out, then market scored a point and all of a sudden the market's coming back and you're sitting there saying, God, what's going on? What's going on? What's going on? And you go straight into hope. I hope it comes back, okay? And then it goes against you. If you don't have a stop loss order, you're in a world of hurt right here. I'm telling you. So remember, score a point, pull back. Think of it as playing a game. And in most games, there are predominantly two sides or two teams. With every game, there's rules and objectives. Both sides are trying to score points. And with most games, there's penalties for cheating. Boy, I'm going to tell you, there's huge penalties for cheating here. And every game should be fun or no one wants to play it. Bulls want the market to go up. And if the market is going up, it will then make higher highs and higher lows. That's how you know you're in an uptrend. When a bull rallies and takes out a previous high, they just scored a point. So let's look at how this works. We were in a downtrend. Look at making lower lows and lower highs. Then all of a sudden, the market reversed, and instead of making lower highs, we start making higher highs, right? And look at how the bulls scored a point with a higher high, then pull back. Look at here, how they came up right to that point, pull back. Then they rallied up, took out these highs, scored a point, pull back. Then they rally one last time, score points here, and pull back. Wouldn't it be terrible to buy this engulfing bullish candle and then get involved in a trade where it rallies, scores a point, and instead of continuing to rally, it literally U-turns again and goes the other way and takes away all your profit? This is what we're looking for. We're looking for, if you traded one lot, scores a point, pullback. Okay, let's look for another trading signal. Here's another engulfing candle. Let's get in again. Now in this case, we may want to go after, since we're no longer making lower lows and higher highs, we have a trend reversal. Let's get in for a little longer time. We get in here, let's go after this point. Market rallies up, scores a point. Pullback. See, that's how this works. And I'm going to teach you a little more in detail how to take advantage of it. Now, a high is different than finding resistance. Highs are candlestick formations where there are two candles to the left and two candles to the right that are lower than the wicks, are lower than the center tip high. And once again, remember, they don't need to be in sequence. This one could be lower than this one. All you need is two to the left, two to the right that are lower than. Resistance is a market high or price level where the bears start selling enough to interrupt and reverse an up move, a rally, or an uptrend. Not all highs are levels of resistance. Only higher highs that have been created from where the market is currently being traded are the current levels of resistance. New highs that are created from where the market is currently being traded become the new levels of resistance. So it's like walking up a set of stairs. Let's look at this. Here's the current price. Here is our looking back on a chart. We go find our first high. That then becomes resistance 1. Then we find another high, resistance 2. Then another high, resistance 3. Then another high, resistance 4. See how we're walking up a set of stairs? So we always start where the current price is. We then go to our first high. Then we go to the next high. Then do we hit the candles? Then the next high. That's resistance 3. Next high, resistance 4. Next high, resistance 5. Next high, resistance 6. And sometimes when you have two highs that are close to each other, you may want to go to the higher high. So once again, it's like walking up a set of stairs. Now, if the bulls take control, because we're clearly in a downtrend, making lower lows and lower highs. If these bulls take control, they're going to reverse this market, and they're going to start waving up, just like this, scoring points. Okay? If we were able to look at this chart from the past, you would see that the bears are scoring points and pulling back. Then they're coming down, scoring another point, pulling back. Okay? Look at how they tried to score a point here and pulling back. You'd be amazed at how this works, and you will be amazed by the end of this lesson. So here's another chart. Once again, here's the current market. We go to the first high, and since these two are so close together, usually if two or more levels of resistance are within 15 pips, go to the higher one of the two. There's your first one. Now look closely. You may want to put your machine on pause. Look closely. As we go up, I have a lot of candles to the right that are lower than the wick high, but not two to the left until we get to here. There's resistance 2, then 3, then 4. You see that? Put your machine on pause so you can really study this. Because if the bulls take control, the market's going to start waving up, scoring a point, rally, score a point, wave back down, rally up, score a point, wave back down, rally up, score a point, come back down. At the end of this lesson, I'm going to prove it to you, and it will amaze you how this works. Take a good look at this chart. Can you find any current levels of resistance on this chart? If this is where the current price is, the answer is there is no resistance on this chart. Only past highs that are past levels of resistance. This is a past high and past levels of resistance. Same with that high and that high and that high. The bulls are clearly in control, making higher highs and higher lows. This is an uptrend. Now let's go through this trading exercise. Let's find resistance on the following charts. Find all levels of resistance on this chart. Now here's the current price. So put your machine on pause and find all levels of resistance. This is the answer. Because this level is close to this level, we go to the higher of the two. Now this is resistance 1. Now this is a high. This is also a high. But we could say this is resistance 1 and resistance 2. But they're within 15 pips apart, so we might as well go to the higher one of the two. So this is resistance 1. Then we go back in time. These are also close. These three are so close. We're going to go to the higher one. This is resistance level 2. Then this is resistance level 3. So on this chart, there are 3 levels of resistance. Now here becomes the spatial intelligence. This is the skill you're trying to acquire. When you turn on a chart, you're trying to say, okay, here's the current price. This is level 1, level 2. Well, these are all close. Level 2, level 3. That's the spatial intelligence. Level 1, level 2, level 3. And you want to try to do this rapidly. That's the skill. Now let's try that on this chart. If this is the current price, find all levels of resistance on this chart. Go ahead and put your machine on pause. There's only one level of resistance right here. This is the current price, and you go back to the candles, looking back up. This is your first high of 2 to the left, 2 to the right. And if we're stepping up the stairs, there is no higher level of resistance. We would have to go back in time. And on these charts, all you have to do is push this button and it'll compress the charts to find them. Now, find all levels of resistance on this chart. Here's your current price. Go ahead and put your machine on pause. Now, spatial intelligence should have you quickly do this. Level 1, level 2, level 3. Let's see if we're correct. Level 1, level 2, level 3. And then to find others, we go back in time. Bears want the market to go down, and they are trying to make lower lows. They score points if they can make lower lows. So let's look at the current market. If this is where the current market is, then this would be your first low, your second low, your third low. Now in this situation, the bulls were clearly in control. They scored points here. Now they pull back. The bears drug prices all the way back down to this previous low. Bears moved the market and scored a point only by making a lower low by 1 pip, and then they pulled back. Now, a low is different than finding support. Lows are candlestick formations where there are 2 candles to the left and 2 candles to the right that are higher than the center wick low. Support is a low that is higher than the previous low. Support is a market low or price level where the bulls Start buying enough to interrupt and reverse a down move, a dip, or a downtrend. Not all lows are levels of support. Only lower lows that have been created from where the market is currently being traded are the current levels of support. New lows that are created from where the market is being traded become the new levels of support. Let's look at it here. Now, if this is where the current price is, then we are now stepping down a set of stairs. Okay? We start from where the current price is and we find the first low. Then we go to a lower low. The first low would be support 1. The second low would be support 2. A lower low would be support 3. And a lower low would be support 4. So if this is where the current price is, this is support 1. We draw a line until we go back and hit the candles. This, because this is really support 2, but they're so close to each other, within 15 pips, we'll go to this low. Then we draw back to this low. And this does not have 2 candles to the left that are lower than, only one. So this is support 3. Then this is support 4, support 5. And then we'd have to go back in time to find a lower low. On this chart, support 1, support 2, support 3, support 4, support 5, support 6. It's just like walking down a set of stairs. Now, on this chart, if this is where the current price is, let me ask this question. Are there any current levels of support on this chart? Now, if you're walking down a set of stairs, the answer is no. There is no current support on this chart. There are past levels of support, but no current levels of support. In order to find any current levels of support, we would have to go back in time and do some research. Now, here's a trading exercise. Let's take the following charts and find support on the following charts. Now, what's marked on this chart are the past levels of resistance that we've already found. So now, let's walk down the set of stairs and let's find all levels of support, starting from here. Go ahead and put the machine on pause and find me the current levels of support. This is your current level of support. There's only one level of support, and in order to find more, we're going to have to go back in time. Find the current levels of support on this chart. There's your current price. Find the current levels of support. Go ahead and put your machine on pause. Now this becomes the spatial intelligence. You should rapidly find resistance. For example, if this is the current price, here's resistance. Then this is support 1, support 2, support 3, and I'd have to go back. Do you see how rapidly I did that? Support 1, this is not support, it doesn't have 2 to the left. Support 1, support 2, support 3. You want your eyes to scan this. Now find all levels of support here. Put your machine on pause. Okay, once again, we're trying to learn to scan our eyes. Resistance 1, resistance 2, resistance 3. And we're trying to do this by having it natural. Support 1, support 2. And to find support 3, we have to go back in time. So the visual you must learn when you look at a chart is you want to turn on your chart, and the habit is to go find 4 levels of resistance and 4 levels of support. I know I only have 3 on here, but that's because graphically we couldn't get 4 on here. So you have to get in the habit of finding 4 levels of resistance before you trade and 4 levels of support before you trade. And if you can't find them on the chart, you must go back in time. Now I'm going to be explaining the why. Now let's watch the game between the bulls and the bears in action. You're going to be amazed how this works. Now if you're a bull, the market should take out past levels of resistance, and your protective stop loss orders should be at the last low or level of support. If you're a bear, the market should take out past levels of support, and your protective stop loss orders should be at the last high or level of resistance. There is no support on this chart. Would you agree? Here's the current price, and there is no support. The lows are past levels of support. Clearly, we're in a downtrend, and the bears are in control. Would you agree with that? Now, if by chance the bulls took control, they will begin to start to make higher highs. And here's your first level of resistance, your second, your third, your fourth, your fifth, your sixth. There's 7 levels of resistance that we can see on this chart. If the bulls take control, they're going to rally these prices to try to score points. So the first thing we want to do is draw our trend lines. You can see we're in a downtrend. This is what's called an outer trend line that we're going to be learning here soon. And this is an inner trend line. Now, if the bulls take control once again, they're going to rally, break these trend lines, and start scoring points. Now, these are your current levels of resistance. Resistance 1, resistance 2, resistance 3, resistance 4, resistance 5, resistance 6, and there's another one up here, resistance 7. Now, all of a sudden, bulls take control. They rally up, break the trend line, and make a new high. When they made a new high, score a point, pull back. Look how they rallied up, made a high, and pulled back. Okay? So now the bulls seem to have taken control. And they've made a new level of resistance and a new level of support. Now, in this trend line right here, the market was bouncing down off the trend line. This trend line, on the south side of this trend line, is resistance. But when we get on the other side of the trend line that we'll be learning, the back side of this trend line becomes support. Now that we're on the north side of this trend line, we have a high probability chance of rallying. So if we rally from here, the bulls are going to rally, take out this high, score a point, and then they're going to go after this high. Let's see what happens. Look at how bulls rallied from here, scored a point. See? Bears tried to drag prices down, couldn't do it. Bulls took control. Now here's what's really taking place. When the market goes down, there's more selling than buying. When there starts to become more buying than selling, prices rally. But it's quite interesting how they rally in the form of a game. They rally until they score a point and then pull back. This is an amazing discovery to understand how the market works. Now, the bulls continue to rally, break the trend line, and score a point. So the bulls now have scored 1, 2, 3 points, and of course, here comes the pullback. Let's see what happens. The bulls continue to muster up energy and score another point, and you can tell by this black bearish candle that there is a pullback right after they've scored a point. The bulls are after these highs. We are incurring a trend reversal. There has been now a total of 4 points that have been scored by the bulls. Now the bulls rally back up, score 2 more points, and pull back. One thing I want you to understand and learn is this. Many times when you have 2 points that are next to each other, the bulls will take out both of them at the same time before they pull back. So now we have the bulls scoring 1, 2, 3, 4, 5 points and pulling back. Now they rally back up. Now look at this. This is quite amazing. Look at how they rally up, score one more point. Look at how this high is just a few pips higher than that high. But they rally up, score a few more points, and then dramatically pull back. This game is never ending. This game started years ago and keeps on going. Okay? And it continues today. The Bulls and the Bears will continue to fight for control and try to score points. Every day when we trade, we must pick a side to either become a bull or bear. If we pick the right side, we end up making money. If we pick the wrong side, we'll end up losing money. The reason we must learn about support and resistance and constantly monitor them is because when it's time to trade, we must either become a bull or a bear, and we must pick a side. We must, if we're going to trade, enter the market and either be a bull or a bear. And we need to learn how to effectively protect ourselves when we trade. If you want to be a bull, you are buying first. Now, if you want to get in the market without using a candlestick formation or for whatever reason, your protective stop loss order must be a minimum of 10 pips below or beyond the last major low or last level of support. Now, why is that? See, the bulls and the bears are constantly testing past levels of resistance, past levels of support. They're trying to make bulls, trying to make higher highs, bears, lower lows. Now, as they test, what they're trying to do is capture interest. Now, if we are in an uptrend, okay, and we want to buy, a great place to buy is when the market gets near support and gives us a candlestick formation. That's a great place to buy. Why? Because if we get that candlestick formation, then that's a sign where the bulls are saying, look, we're going to take control. Now, this will allow the bears to test that low and see if there's interest in dipping further. If there's no interest in dipping further, the bulls will take control, rally, and try to score future points. Now let's talk about an exit strategy. If the bulls are rallying and they score points and then immediately pull back, isn't it wise to go find a past high and exit 10 pips before the bulls make a new high and then pull back? So the habit then needs to become the following. When you enter the market, go find 4 past highs, pick a high that lends itself to equity management to where you get the proper return on your money, and exit before it hits that high. Now let me show you this example. The market's rallying up and then it's pulling back. Bulls have scored points. You can see this trend reversal. We were making lower highs and lower lows, but now we're making higher highs and higher lows. Now look at how close. This is support right here. Look how close to support we are. Now for whatever reason, let's just say we get in. Okay? We get in the market and our stop has to be at the last major level of support. This is about a 50 pip risk. We can then acquire this reward. If the market turns around and rallies, there's a lot of money to be made here, maybe 200 pips. But see how our risk and reward ratio have to be in check? We are going to place our stop order 10 pips below the last low, and then if the market rallies, we're going to get out 10 pips in front of the previous high or level of resistance. That lends itself to a proper risk reward ratio. Now, if you want to be a bear, you are selling first. We're going to turn everything around. If you want to get in the market without using any candlestick formation, trend line, whatever it is, you just have this feeling, and you're going to learn that I'm totally against feelings when it comes to trading. If you short the market and get in, your stop loss order must be a minimum of 15 pips above or beyond the last major high or latest level of resistance. Now, why 15 above and 10 pips below? Because we're watching bid charts. So the rule is 15 above, 10 below. Now, this will allow the bulls to go up to that high, test it, because you need to stay out of the way of that test and see if there's interest in rallying further. If there is no interest, the bears will take control, dip, and try to score points, making lower lows. Your exit order then, if you shorted the market, now think for a second, if you shorted the market and you put a protective stop above the last high, and bears are trying to create lower lows and take out past lows, then what you want to do is you want to exit 10 pips in front of or before the market makes a new low, allowing you to exit for a profit before the major pullback after they score a point. Now let's look at it in a chart. All of a sudden, the bears came down, didn't score a point, but they pulled back, and now you want to enter. So let's just say you sell. If you sell here, for whatever reason, because you don't have any candlestick formation, you sell here, your stop needs to be 15 pips beyond resistance level 1 or the first or past high. Then, for profit taking, you may want to consider getting out 10 pips in front of a low. Now, here would be support 1, support 2, support 3. So if the bears maintain control, they're going to come down, make a new low, then pull back. Probably will come down, take out these two lows at the same time because they're so close, and then pull back, U-turn, come after this low. So the rule is this. If you're shorting the market, your stop order must go at a previous high, 15 pips beyond the high, and you will then exit 10 pips before the bears score a point. If the stop order is too far away from the entry point and does not meet your equity management requirements, pass on the trade. Now let's look at this. There's no candlestick formation telling me to buy, okay? So, but if for whatever reason I say, okay, I'm going to buy, which is a dumb move, but if you want to buy and your stop order needs to go 10 pips beyond the last low, this is 140 pip risk. Way too much risk. Okay, I really believe you shouldn't risk more than 50 pips in any given trade. I will be teaching you how to find lots of trades that only require 50 pip risks. So when the risk is too great, get in the habit of passing on the trade. And never trade without a protective stop loss order. Never. This market can really get away from you. And what usually happens is if you ever trade without a protective stop loss order, this is what will happen. You'll probably get away with it. And that's the worst thing in the world that can happen, because if you get in the habit of trading without a protective loss stop order, believe me, it will only be a matter of time that you will be introduced to the word, to what I call the Louisiana Cajun word, liquidation. You will become a victim of liquidation, which means your account will probably be liquidated when this market goes the wrong way or against you. And here's some traders' tips. Current levels of support and resistance are best seen on time frames of 1 hour and greater. Smaller time frames of 30 minutes and under have a tendency to create what I call false levels of support and resistance. On smaller time frames, there's a lot of wave movement that is called market noise. The market noise can confuse traders and create highs and lows that are not necessarily support and resistance. Now, in a future lesson here, I'm going to be teaching you the importance of keeping track of what is called your ABCDs. You must get in the habit of constantly monitoring your current ABCDs, just like you'll constantly monitor support and resistance. Let's watch how past resistance can become future support. Now, as the market moves, it has a tendency to return back to levels of support and resistance, meaning in this uptrend, what the market likes to do is see how this was past resistance. As the market moves up and waves, it likes to come back to past resistance. Now, when it pulled back to past resistance and the uptrend stayed in place, look at how it created this nice morning star. And from there, it bounced. So, in an uptrend, when the market pulls back to past resistance, look for candlestick formations to get in. Because if a candlestick formation appears, the market's probably going to bounce. And boy, that's exactly what we want. We want to get in where the market bounces in our direction and goes our way from the beginning. So look to buy past resistance if a candlestick formation appears. Now look at this uptrend. Look at how many times, here's past resistance, the market pulled back, didn't give us a candlestick formation there, rallied up, made a new high, bull scored a point, pulled back, past resistance. Look it out at that past resistance, a bullish candlestick formation appeared. Look at, if you would have bought this, put in your stop at this last low, look at all this profit here. Then the market pulls back. As it pulls back right through this whole process, all of a sudden we get a double bottom, somewhat of tweezer bottoms. Look at how long this wick is, and not quite meeting the criteria, but you get a double bottom and the market takes off and makes a new high. Then look at past resistance becomes future support, market pulls back, another engulfing bullish candle, okay? Then rallies, makes a new high, pulls back, provides us with an engulfing bullish candle right here, rallies back up, makes a new high, pulls back, and through all this stuff creates a nice morning star right in here, and then rallies up to the next level. So as the market pulls back in an uptrend, look for your past levels of resistance, and then look for candlestick formations so that you can take advantage of the market as it moves forward. So what we want to get in the habit is look for reasons to buy near past resistance so that it can become future support, and look for those candlestick formations as it does it. Now, past support can become future resistance. The opposite will take place. In a downtrend, the market pulls back. Look at, here's past support. Look at how it formed these nice tweezer tops. Great signal. And then begin to fall. Here once again, past support, pulls back, nice engulfing bearish candle, falls. Then here's past support. Look at how it pulls back, creates these nice tweezer tops, then falls. So once again, we're looking to sell past support, which can become future resistance, and we're looking for candlestick formations. Now, selling resistance and buying support. Watch how this works. Remember how we discussed trading ranges? Trading ranges are the difference between the high and the low of a time period or a trading period, i.e., the trading range of the day versus the trading range of the week. Now, the market can create two trading ranges on a chart at the same time. Here's the high and here's the low of the chart. That then becomes the trading range of the chart. Here then is the low and the high of this day on 12/14/2004. This then becomes the trading range of the day. Now, many times, if the market's not trending up and it's not trending down, it has a tendency sometimes to just go sideways. When the market goes sideways, it is creating equal levels of resistance and equal levels of support. Now, in a large trading range, what's a large trading range? 150 to 300 pips. When the market is bouncing back and forth, creating equal levels of resistance and equal levels of support in large trading ranges, what we want to do is sell that resistance and buy the support. Now think about it. Look at this engulfing bullish candle at support. Market rallies. We want to take the ride to the other side. Then we want to short the market and take a ride to the other side. All of a sudden, an engulfing bullish candle appears. Look at how the market rallies. I love how the market communicates. Then an engulfing bearish candle appears. Market goes to the other side. Then what happens? What will you do if there is no selling or buying signal? Well, this is a 4-hour chart. What you will learn to do is get in the habit of turning to a smaller time frame instead of looking at a 4-hour chart. When the market works its way to the other side of the trading range, you're going to turn to a 60-minute chart, a 30-minute chart, even a 10-minute chart, and look for morning stars, tweezer bottoms, engulfing bullish candles, which will be the sign that the market's going to U-turn and take the ride to the other side. Once it gets to the other side, you're going to look for evening stars, tweezer tops, engulfing bearish. Believe me, they will be there. So when it's time to sell resistance, we're going to look for bearish candlestick formations, and we're going to take the ride to the other side of the range. And when we get to the other side of the range, or close to it, we're going to turn to a smaller time frame. We're going to exit out of this trade. We're going to turn to the other time frame and look for morning stars, engulfing bullish, tweezer bottoms. Now, did this lesson teach you that trading is a financial game with two sides, bulls and bears? Did this lesson teach you how points are made between the bulls and the bears, and that each side is trying to score points against the other side? That traders try to capture pips as the bulls and bears fight for control and try to score a point? And that you, as a trader, you need to understand how the market moves and don't fight the market. You need to learn to go with the market. The only way you can learn to go with the market is to understand how the market works. So did this lesson teach you how to find support and resistance, and the importance and significance of knowing where support and resistance are? That support can become future resistance and you can enter selling there, and in the same way resistance can become future support and you can enter buying there? Did this market teach you where to place those protective stop loss orders and how to profit take and exit the market before it hits past levels of support and resistance? Did this lesson teach you how to place your protective stop loss order a little beyond past levels of support or resistance, and more importantly, to never trade without a protective stop loss order? If it didn't, you need to play this lesson again until you clearly understand the importance of support and resistance and the game between the bulls and the bears, so that you can learn how to successfully take advantage of this market. On behalf of everybody at Market Traders Institute Worldwide, we'd like to say thank you for taking the time to properly educate yourself and for investing in yourself. This is FX Chief.